Hey traders, Stephen Quitzel here. It's Wednesday, October the 2nd. We have a lot to cover today. We're going to look at the individual market indices, breadth, potential support zones, individual industries, ETFs, what's holding up, where the money is flowing into, and we're going to look at a couple commodities. So we'll just really dive right into it. You can see, the last several days, the market, the NASDAQ broke the 50-day moving average. I believe it was on Thursday or Friday of last week, and then the 50-day, this S&P followed. So, sometimes one is leading the way down and one is leading the way up. But, right now, the market is a little bit off the bottom, but I don't have, we got a little bit more than an hour left in the market day, but I don't have high expectations that we're just going to completely reverse off the bottom and close green. But any support would be good. Now, if we look, I want to start with the NASDAQ right here, and there's really one thing worth noting. We are at this, we're probably at about a 6 or 7% sell-off in the NASDAQ. But, if I go all the way over here and track this, we are at the same price the market was on March 20th. We go all the way back to March 20th. So, that just goes to show you kind of how challenging it's been. I think this was fine right here. I even think this was fine because you kind of knew to get out of the way. This was a clear downtrend. This was a clear uptrend. So you get out of the way, you get back in. But this has really been choppy since the very beginning of August, right? The market was in a trading range. It tried to break out on this day, and I thought it was going to run, but then it just started to weaken a little bit. And then I was like, uh-oh. And then the NASDAQ broke, and then what's interesting is then you follow the green line, the rally line is, the market will find support at the 20-day and then it'll find resistance. And look at how many days in a row it just hit that 20-day EMA and then just got sent down. So, but I think the most interesting thing on this chart is just kind of go show you how challenging this has been. But we are approaching long-term support. But, the market price action really hasn't gone anywhere in 6 months. So I think it's important to always have realistic expectations to say, okay, we're not going to get this type of trend all the time, right? The market can't go straight up. It's going to go up for a little bit. It's going to consolidate. It's going to go down. It's going to go up for a little bit. But I think it's important to always look for bullish setups. That way you don't have a bearish bias, and when that bull market signal happens, or when that bullish signal happens, you're not sitting there, just saying, oh, it's going to fail, it's going to roll over. So that's the mistakes I've learned in the past. But, 6 months where the market has gone nowhere, has made swing trading a little bit challenging in the last couple months, most definitely, because, I like fast moving growth stocks. I like good earnings, good support, but I like fast movers, and they just haven't been moving the last 3 weeks. I mean, they really, I put out a top 10 report every Tuesday. They just haven't been going anywhere. So a lot of times that's also telling me something. And sometimes it can be an early warning sign when when a lot of the setups you're looking at just aren't moving. That sometimes tells you need to keep your powder dry. Just be very cautious. And then when 3 or 4 or half the list starts to break out a little bit, then you can start to really scale in. But with the S&P 500, I drew these levels, right? And forgive me, I mean, they're not exactly parallel or straight, but the point I'm trying to make is, so let's look at the S&P 500, and the S&P 500 looked better than the NASDAQ. It broke the 20-day, the 50-day after the NASDAQ, so it was holding up there a little better. Now it's actually doing a little bit worse today. Finally gave way. But a lot of times you look at these little stop run levels, and sometimes the market can just blow through them very, very quickly. And they can be very, very little levels that, kind of act like a magnet to the overall price action. So, this right here, and that's why kind of waterfalls happen, right? Like you had this waterfall over here, and you had all these tiny levels where someone's got stops, and they just blow through them. And that's why acceleration really picks up to the downside. So right now, we have these levels, and I'm not sure if they are just going to completely go through them, but that's kind of what I'm thinking. Now, what I think is probably likely to happen is it blow through these levels and then find some kind of support. You get like a support bar probably at the 200-day moving average. Okay. Not a prediction, but if you look over here at how these levels were just absolutely picked off and ran through, you kind of have to look at history and say, okay, you know, this was the beginning of a waterfall. You had one day right here, and then you had another day. It can be last 2 to 3 days of just kind of panic selling. And I think we could be halfway in, and we could get, you know, a bad week, and then all of a sudden you have some very, very nice setups. So I'm showing you this just to show you the possibility and to show you what happened right here. It's not to go out and sell everything, because I think that's absolutely silly, but it's more to say, okay, this is what happened right here, and when it ran all the stops, then a bottom got put in. This could happen right here, and by the way, when that last stop is ran, it could be a support bar at the 200-day moving average. Don't know if that's going to happen yet. I'm always going to keep an eye on this chart. It's the red line, the 20-day EMA, to see how the overall market is going to be acting. But, you know, one has to hope that the market does find support in, if it gets down here at this 200-day moving average, but I would kind of expect for it to pick that off. Now, if that happens, and even there's a smaller level down here, if that happens, that doesn't necessarily mean that, you know, it's going to come down and pick off this level. I would be surprised, actually, if that happens. I think, you know, it's just, you gotta look at it as a nice shakeout. The market likes to pick you off, it likes to shake you out, and then it will make a move. You know, right here, the 200-day moving average broke. This level got picked off. This level got picked off. 220. This level missed, but the 200-day moving average broke. Everyone thought the sky was falling, and then boom, came right back. So just, I think this is a perfect example just to show you, don't, you know, shut the computer or sell everything and then completely ignore the market. You know, try to hang in there as long as you possibly can. So I have right here a zigzag chart of the NASDAQ, and I think this is, you know, actually let me make this even easier. Let me kind of take one of these off just to show you, and let me kind of blow this up a little bit. Okay, so what this is a zigzag 20%. So every line, every bar is a 20% move, can be an intraday move. You know, it doesn't have to be a close-to-close move. A 20% move in the price action. So you can see right here that, you know, the NASDAQ, it had a bear market in 2011 and then just went on a massive run, and then had a bear market obviously last year, and then moved up 20%, and now it's on its next leg that hasn't finished. So why I think this is important to show you is because I think when the market is more in, you know, that 8-10% correction, I see those definitely as being more opportunities instead of waiting for a big 20% bear market to move your chips in the middle. Because, I mean, look at all these extra opportunities you have. Every line, every zig or zag is a 10% move. So you have, you know, a 10% move this way. You could have added some money right here. Another 10% dip, you could have added more money. 10%, 10%, 10%. Not everyone is an absolute winner, but my point is that you need to, in my opinion, you look at these moves, you look at these corrections as more of an opportunity, because the long-term trend is much, much greater, right? And if you're at a 10% correction, you put in some money. You can always put a stop loss in just in case you're wrong or in case you're early, and let it trigger, and then do it again, because eventually you're going to get it. But, you know, you don't have to blindly buy. But I think, you know, sometimes looking at this, or even sometimes if I go down here and look at, you know, the RSI 14, and you can see that really hasn't even happened a lot on the NASDAQ. This is on the weekly chart, but what if I go to the daily chart? So you can see it's happened a lot more times. If you were to buy coming out of an RSI 14, more opportunities, and most of these would have been a great opportunity. And you get a lot of double dips, right? You get a double dip right here. But my point is, just don't always think that everyone's going to be the big one. Just use these opportunities if you have some long-term positions to potentially add to it, because, you know, most of the time the market does turn around. Now, I know there's, you know, the wall of worry on TV. You got the election, you got the trade war, you got manufacturing, you got every possible thing you could think of. we're still at 5% away from an all-time high. The S&P 500 is. So, I mean, how bad could it really be? Yes, there could always be more downside, but take the bullish stance is what I'm saying. So if we go right here and we look at the breadth. Now in the short term, it's not looking good. Okay, so in the short term, it's not looking good. But why? Sometimes I like to look at a 10-year chart just to show you all those 10% downside moves in the past. None of them looked good. None of them look pretty. We're not even there yet. But, the market overcame. Now, in the short term, you can see kind of where the weakness is really getting. 32% of the stocks are in the S&P 500 are above the 20 EMA, so that's not really trending. My guess is most of them are going to be in the utilities. Yep, that's really kind of holding up. You have utilities right here that are holding up at 96%, so utilities are really hanging in there. Staples, right, also are hanging in there, and I assume some REITs are hanging in there too. Whereas you have energy, the XLE that's getting really, really weak, and we'll look at an oil chart. Industrial, that's weakening. You can see discretionary is kind of holding in there. Financials are really weak. Everything's really weak. It really looks like the defensive names are keeping it above 30, but that's probably going further down. Another thing to keep in mind is a lot of times the breadth, once this could be a short-term bottom, but a lot of times the breadth does take another leg. Once it comes across this level, it'll come back down. See the first dip below, came back down. Same thing here, came out of here, and then it kind of chopped around a little bit before it kind of sucked us all in and then fell out. So very, very short-term indicator, just goes to show you kind of where the money is, what is holding up, and it's clear to me that, staples, utilities, those are the ones that are being the strongest, which you would absolutely expect. Right here, the long-term breadth, which is kind of what I prefer to look at. 63% of the stocks in the S&P 500 are above the 200-day moving average. That's still bullish. It hasn't turned bearish yet, unless it gets way down here. That's when I would consider bearish. If it, pinballs around in the middle, it's more of a trading range, which that makes a lot of sense because we're basically back at the same price that we were in March, at least for the NASDAQ we are. So right now it's trading. We're going back into a trading range at best. And again, we're going to look and see if those stop run levels that I showed you, I already put away that chart, if those stop run levels are hit. But I'm hoping that we can find support at the long-term moving average. This is a chart, the chart of oil, that really hasn't changed much. A lot of you are probably tired of seeing this chart, but I think there's been some major developments. And I was talking about a couple weeks ago when I did my last webinar, you really had this wedge, this triangle, and it was the price action was getting smaller and smaller. And I said it's eventually going to have to go one way or the other. 3 weeks ago, you had the Saudi crisis, or the Saudi oil fit hit, so it jumped, but now it's just coming back the other way. And looking like that was a false breakout, which could mean an above average move to the downside. And now this is a weekly chart, so this is a very long-term chart. This doesn't turn, it's not going to turn by the end of the day, but look right here, you could have, remember I was talking about these levels, these stop run levels that could get picked off. You could have, now that it's breaking down a little bit, these levels could be blown through very, very quickly. And, I don't know where oil would settle, but from the looks of it, it looks like oil is going to break down versus breaking out, which we thought about a couple weeks ago. Now, this is a very, supply, demand, Middle East, fundamental, anything could change the price. The direction of this oil. But, if I was just looking at the chart, didn't know anything that was going on, I would say oil is going to break down. Because, I talked about this 3 weeks ago. You want the stocks to outperform the commodities they track. So I have this relative ratio, XLE, energy stocks versus the actual price of West Texas oil. And you can see right here that it is just drifting, and is not outperforming, and hasn't, all of 2019, hasn't been outperforming oil. It's been underperforming. So you want to own energy stocks when they are outperforming oil. So when this line goes up, when this trend line breaks out, that's when you want to go long energy stocks. I'm just not seeing anything exciting in energy stocks at all. Not to mention, the relative ratio of energy stocks versus the S&P 500 is still weak, right? This has been going down for years. You have rallies, yes. You had 2016, that was a strong rally for oil off the bottom. Energy stocks were outperforming the S&P, but 2017, 2018, 2019, for 3 straight years, energy stocks have underperformed the overall market. So, a lot of times I like to look at these relative ratio charts, say, okay, is this a sector I want to own, for the next, 6 months, 12 months, much longer? And if it just can't outperform the index, the normal index, why would I own it? Okay? So I think oil just is looking very suspect to the downside. So I would just be cautious on buying pullbacks or, dividend MLPs or anything like that, because this could go to the downside. Now on the flip side, this is also a chart I keep showing, and this is another long-term chart. This is gold. I'm still bullish gold long-term, but again, this is a very, very long-term chart. Gold has gone up very nicely the last 12 months. It could consolidate for another 12 months, but you peaked in 2011, created this deep, deep consolidation for 8 years, and then cleared some major, major pivots as it's climbing the right side of this consolidation. I think this could easily pick this off within the next couple of years, the 185, and then who knows, maybe it can go on a run like it did from 2005 to 2011, where it was up 350%. That's just the ETF GLD. That's not any miners or anything like that. So is that going to happen? I have no idea, but I think this is a bullish setup, and I think the tables are turning for miners and gold in the long term. So I would just be very, very aware that this technical setup is happening, so you can potentially take advantage of it. I don't know. Looking at this chart, it's going to be much, much harder to swing trade. I think that, if you decide to look into some long-term gold or some gold or miners, more look at the long term, because in the short term, they're very, very volatile. Now, this is the CRB versus the S&P 500 relative ratio chart, because I get asked commodities all the time. They're sexy. I get it. What can these things do? They can go parabolic, but at the end of the day, you have a relative ratio versus the S&P 500 of the CRB, which is a basket of commodities. And you can see clear as day that, really the S&P 500 has been outperforming, because this line is going down, has been outperforming commodities. Honestly, it's been outperforming since 2011. Now you have these 5 to 8 year periods where, they can make a shift and commodities can turn up and outperform the S&P for 5 to 10 years. But until that happens, it not only needs to break a trend line, in my opinion, right, break this down trend line that has been going on since 2015, which it's close, but in my opinion, not only needs to break out, it needs to come back, and it needs to break out of that little mini pivot, the thrust. So something really, really needs to happen, and right now I think oil is just going to drag. Even though gold looks good, I think oil is going to drag it down. Plus the dollar is looking really, really strong right now. So I wouldn't try to get too fancy and try to load up on commodities or, overweight commodities or anything like that, because right now I'm thinking a simple commodity ETF. S&P 500 is still in the lead, and as far as I'm concerned, it could take, a 6-month trend change to really, really change my mind, or change, whatever the information is on the technical chart. It's going to take a while. So again, I would just be cautious. Oil looks weak, gold looks strong, but stocks still look stronger than overall commodities. Gold looks stronger than stocks, but as a whole. So let's kind of go back here. We're getting some more buying off the bottom, but again, like I said at the beginning of this presentation, that kind of buying doesn't excite me. It hasn't really moved a ton, but it's interesting that the Nasdaq is slightly doing better than the S&P 500, but small caps are down the least. So I'd say that is always a plus. Let's go look at the sector summary for the day. Even REITs and utilities are down today. You can see utilities are down almost 1%. REITs are down 0.76%. Energy is down the most. That makes sense because the oil chart looks like crap. But you got materials, technology. Yeah, Staples is down here, but still. The defensive names are down the least, but they're still down. That's why I would just rather be in cash when the market starts to sell off. In the last 1 month, utilities have been the strongest, up 3%. Financials got a boost as the yields really bounced off the bottom, which makes sense, but as of lately, they look weak. But you can see right here, healthcare is really not looking strong out of everybody. So I think there's a lot of uncertainty around healthcare. It could be I'm sure it has to do with the election next year. You don't know, who's going to win, what's going to happen. So I think there's going to be a lot of uncertainty around the healthcare industry. I think there's just better places to be. Plus that chart is in a major trading range. If we kind of look at it right here, whoops. Let me just kind of blow this up. Yeah. I mean, look at this. This healthcare, and even if I go back, let's just go back 2 years. I mean, it's gone nowhere really in well over a year. You can see right here, it's actually lower than it was 12 months ago. So, and I could draw a trend line right here, and I would say that trend line is breaking today. So, healthcare is looking weak. I'd probably stay away from that. Let's go look at the individual industry summary just to see in the last 1 week if there's any aggressive sectors that's holding up. So that's what I always am going to look for. Okay, so I always look for, when the market's selling off, what aggressive sectors are holding up. And home construction, we can look at that. That makes a lot of sense because interest rates have been cut. That's going to be good for housing construction, even though there were some unfavorable reports that recently came out. Staples, I mean, that's not aggressive. Energy, renewables have gotten slaughtered lately. This is just in the last 1 week, by the way. Financials, there's no green there. Healthcare, there's no green. Industrial, REITs, technology, there's no green. Utilities. So it's really interesting. Just when you look at this, out of all of these individual industries within the sectors, the really only aggressive one is, in my opinion, would be home construction. So let's look at those stocks. So in the last 1 week, you probably have the bigger names, the Lunar, KBH. You actually have some B share. I think those are the B shares. So, but these charts are looking really, really good, really interesting. Look, man, I wish I still owned this. We bought this, I think, right around here and held on to it because the market tried to roll over a couple of times and sold somewhere around here. Then once it hit a target, and then of course it just continued to take off. So, but KBH looks really, really good. These are stocks that could run for a long time. Lennar, the chart, at least as of recently, looks similar. So if I turn this into a weekly chart, why I think they could continue to run for a while is because, I mean, they never even came back anywhere close to reach their January 2018 high. They have a lot of catching up to do, so they are coming deep out of here, and I bet I could draw a trend line right across here, and it looks like an inverse head and shoulders. You got the shoulder, the head, the shoulder, the neckline, and it's just now starting to break. Now, that chart's probably a little extended. Let's just kind of look at KBH. It not as a definitive shoulder right here, but again, I could draw a neckline right across here and say shoulder, shoulder, head, shoulder, neckline break. This sucker is gone. So it's interesting also. You had a weekly reversal pattern right here, nice volume bar, and then it just continued to really accelerate to the upside. It's very unfortunate for me, but I know some people still held on to it. So let's look at the strongest ones in the last 1 month. So some names that I know, just kind of looking across. I wonder if this is, yeah, that's too thin. Not going to look at that. New homes, nope. These are, nope. Let's look at this one. So this actually one doesn't look as strong as the other two, but I mean, it came straight off the bottom, made a nice little consolidation, nice little shakeout down here, and now it's breaking out of the top of this consolidation. So for the most part, it's clear to me that home builders are the aggressive industry that's standing out above all of them. Now, I shot this a couple weeks ago. We looked at some of the strongest ETFs, and I like to rank them. I have about 250 right here, 245. I like to rank them by 3 months because I like to see what new trends are emerging. So I usually like to look at a top 10 to see, okay, what is strong? Are there any things I should be paying attention to? And right here you have palladium that, this obviously has a mind of its own, is looking really, really strong, very strong right there, and is even up today. So in the last 3 months, it's the strongest as far as relative strength rating goes out of all the 250. And what do you know? Home construction is up there too. So it's also interesting to see that, home construction doesn't quite have the shoulder to shoulder as the Lennar and KBH, but the chart looks very similar, and this could come all the way up to here to an all-time high. So what's interesting about home construction is you can see when they can be out of favor for a long time, and then it can just be a smooth ride. So out of favor for a long time, and then you're starting to get smooth. It could go. So you have utilities up here, cocoa. That chart doesn't really look good. Utilities. Japan is still up here. So you have in the last 3 months, Japan. I think the chart has looked interesting, probably because it really came off the bottom really, really strong right here, but it's not doing very good in the overall market today. So you have some Japan ETFs, some Taiwan ETFs, TLT, mostly a lot of alternative investments, everything from palladium to, I want to say alternative, just non-US equities, utilities, Japan, Taiwan. You get the Nikkei right here. So I'm wondering if anything else is standing out. Not really. Not really at all. Now, when I scan this for, okay, what is the strongest today? Today, as the market's not doing very well, look, palladium is actually not only the strongest on the 3 month, this is the strongest today. Silver, precious metals, miners, all looking pretty good today. All commodity related today. It's kind of interesting that Hong Kong is actually up given their unrest, but that chart looks not very enticing. So mostly metals today and miners, so that makes a lot of sense. So I think at the end of the day, I think this palladium is worth looking at. I think long-term gold is worth looking at. Home construction could stay strong for a while and could really buck the trend. That's what is looking like is going to happen. We'll just have to wait and see.